We want you to plan for success. Welcome to Planning Matters Radio.
Well, hey folks, welcome into the program. I am Peter Rashan. This is Planning Matters Radio. So glad you could join us on the program. We are going to be talking about your money, your finances, your plans for the future, your retirement, your security, and confidence. And if you have questions about any of those things, we are here to help and assist at Rashan Planning. You can go online and find us at richonplanning.com. Now, that is my last name, Peter Rashan, but it looks like richonplanning.com. And from the website, you can actually request a copy of my book, Understanding Your Investment Options. You can get that for free, a digital download, or if you choose to leave your name and email or phone number, we can be in touch and arrange to get you a physical copy of that book. It is not the most exciting book you will ever read, in full transparency and honesty. It's probably the cure for insomnia, but it's important information. And if you want to get a general understanding of the different options that you have for deploying and putting your money to work, I think it's a great place to get started. Obviously, that's a biased opinion, but I hope you find it helpful if you do choose to request a copy. Again, you can go to richonplanning.com, request a copy of my book, Understanding Your Investment Options. So that's to get started. Also, we do offer the opportunity for a complimentary planning review and strategy session, and we'll even put a physical plan together for you. We call it the Optimized Retirement Plan. It looks at your income, your investments, your taxes, your healthcare, and your legacy, and all of the aspects of planning, giving you a snapshot of where you are currently. We will discuss your goals for the future and give you a timeline of executable action items and steps you can take in order to turn those goals into future realities. What we believe will be in your interest to give your financial progress some push forward and to make progress toward those goals. So again, if you'd like to get in touch, if you'd like to get that process started, go to richonplanning.com or give us a call, 919-300-5886, 919-300-5886. And we've only been on this group of radio stations for a very short time, but I've actually been on air with financial radio programs for almost 20 years now. My background is actually in radio. I kind of have a non-traditional path to where I am in my career, and I can actually trace it back to a love for music as a child. I moved to North Carolina pretty young. I think I was 7 or 8 years old. It was first grade. Before first grade, I moved to North Carolina. And I didn't have a whole lot of friends, but what I did have was my radio, and I used to call up to the local music station. And actually, that same station is around today here in my local area in the Triangle. It's G105 was the station, and I can remember that pretty well. But I used to call up and ask if I could guest DJ and introduce one of the next or upcoming songs. And from there, I would just say, "Hey, coming up next is New Kids on the Block," and I would then, with my tape cassette recorder, record the radio program and listen for my voice and the song I had introduced to come up. I'd record that, and then I'd sit and I'd edit the tapes back and forth. And after a few months, I had a whole tape of me being a DJ on the music radio station. It was kind of that love that carried me through taking courses in radio production in middle school, in high school, and in college. I graduated with a degree in communications, media studies, and production. I got out of college and began running talk radio stations. So it was a little bit of a transition there, but it was still because of that love for music that I had at a young age that got me to that point where I had the ability to be in radio. And I was running 4 talk radio stations in the Triangle. I was the morning show and afternoon show producer for 680 AM WPTF. I was running WDNC, WDNZ. Those are a couple little smaller stations. I was running a station out in Goldsboro. And I also I was the program director for an online upstart station, stategovernmentradio.com. All that being said, I was hosting several hours of financial talk programming each week with a bunch of local financial advisors. And as humbly as possible, after a few years, I figured out that I knew what I was doing there. And in fact, I had a knack for this, and I really liked it and enjoyed it. My mom was a single parent teacher. So, money was always tight. Making ends meet was not always the easiest. She taught me how to balance a checkbook at a pretty young age. It's not a skill that everybody had, but I did understand money. I understood the math behind it. Math has always kind of been my forte. But not everybody has a great handle on that. Not everybody understood that. And I realized that I did. I also realized that in radio, unless you're willing to move to New York or Chicago or LA to make a name for yourself, the earning ceiling hits you pretty young. And as a young 20-year-old, I was told I had hit that earning ceiling, but I should go ahead and move to New York or Chicago or LA. And if I didn't make it there, I would be afforded and I would be paid a bus ticket back to get my job back. And it was at that point that I realized, hey, this is something I really need to look at long term and figure out if this is the career I want to be in, because I really liked this area that we are in. And I've visited a lot of places and never really had the desire to move anywhere else. So I approached one of the advisors that I was hosting the show for and asked if I could help him produce his program, get it syndicated, get it out there on more stations. And we ended up being on about 150 stations across the country at one point in time. And I sort of became the financial advisor, meeting with all of the clients and meeting with all the people who had questions about their finance. And we did a little bit of a career swap. He ended up being on the radio everywhere that we got him out for. Anyway, I came to the realization again in about my mid-30s that I wanted to do this for myself. But there was a day that really changed my trajectory and my thought of the approach I wanted to take with money and finances and helping people to plan their future. And that day was back at the radio station after I had been hosting all of these financial shows. And a guy named Dave Ramsey came to town. And he actually ran his program out of the radio station that I was the program director for, out of the 680 WPTF studios. At that time, that's the station that he was on. Now he since has changed stations, but that's where he was at the time. And I got to run the board for him. And I listened to his program, and I had battled my way out of credit card debt. I got out of college with a nice 5-figure credit card debt. And it took me several years to dig my way out of that. And Dave came along and I heard his program for the first time, and he was talking about how you should get debt free and how you should live this debt free lifestyle and how debt is not nobody's friend. And then once you're out of debt, you can begin to build wealth. And I was right at that same critical point, and I had been hearing a lot of other financial influences and voices and opinions and perspective. But I said, this guy makes a lot of sense. And so I've been following Dave Ramsey's teachings really, really ever since that time. And when I formed my own company many years later, about 12 years later, I went and applied to affiliate myself with Dave Ramsey and become that SmartVestor Pro in my area. And that took a little bit of time because things are, I guess, a little limited with how that works. And you got to have the space, and you got to have the credentials, and you got to have some background that is done, some interviews. But eventually I was able to become a SmartVestor Pro with Dave Ramsey. All that to say is that, I'm here to help really anyone at any stage. I remember back in 2007, as I was just beginning to enter into actually being an advisor, and I was helping people set up plans that were safe and protected, and they didn't have the risk of loss, because I started in the financial services on the insurance side of things. And insurance has products available where you have no risk of loss. The market will not affect your principal. You will not lose money. And then 2007 and 2008 happened, and the clients that I had at that time didn't lose anything. And in fact, they were beginning to make gains and further progress as everybody else was just digging their way out and clawing back to break even for the next several years. And so I was a lot of people's hero at that point in time. But for the next several years and the decade following the Great Recession, the products that don't have risk, they don't tend to make as much in gains. Now, you don't need to if you don't take big losses when everybody else does. But there's also a balance in expectations. And so people were saying, hey, we would like our money to grow more. And so I got securities licensed and began to help people invest their money over that course of time. And now I am a duly licensed financial professional is what it's called. I can do insurance, which is commission-based products generally, or I can provide advice and guidance and manage and monitor investments. And I do so on that side of things under a Series 65 SEC designation, which is an IAR, Investment Advisor Representative. And I have a fiduciary responsibility on that side to my client's best interest. Whenever making recommendations on investment strategy, on investment management, on retirement planning, I have that fiduciary responsibility, meaning it is a moral, legal, and ethical requirement. And the big ones there are moral and ethical, that I put the best interest of my clients first. And that's, I feel, maybe the most important distinction in the financial world. You need to make sure that you're working with a fiduciary. I think that matters a lot. That is very important. I at least take that very seriously as the responsibility to my clients and for my clients' best interest. Again, if you're looking for an advisor, all that is to say, we are here to help and assist, and we will help and assist anyone who asks for that help and who is taking their planning and their financial future seriously. And that's kind of the criteria. If that's you and you'd like to get a plan put together, pick up the phone and give us a call, 919-300-5886, 919-300-5886, or go online, richonplanning.com. That's richonplanning.com. That's my last name, but it looks like richonplanning.com. So here we are on a cluster of religious stations talking about money. And I'm going to talk about politics as well. So I don't really know if there is a deeper hole that you can dig yourself into, a deeper pit that you can jump into than talking about money, religion, and politics. But here's the thing. Politics has effects on your money. It influences your money and your finances. There's no question about that. Since I can remember, politicians have always been talked about lowering taxes. We will not raise taxes. We will lower your taxes. And the way that we as Americans have saved for our financial future, for retirement, has always been told and taught to us to defer and delay paying those taxes because we would pay lower taxes once we retired. And that has actually worked out. Tax rates have gone down. The income levels that make the thresholds for what tax percentage you pay have gone up significantly, meaning that we are paying lower taxes now than a decade or 30 years ago. If you were a worker, a wage earner in 1986, in order to get into the upper 30% tax bracket, you had to be making about $68,000. Today, in order to be in that upper 30% tax bracket, you have to be making over $600,000. And so taxes have come down significantly, but we are hearing a different language, a very different tone in the language of politicians today. And there are several different levels of taxes that the current, those in power right now, the current administration is talking about raising into the future. And this should be something that every saver and investor who is taking their planning and their financial future seriously is paying attention to. They're talking about changing the income tax rates. They're talking about changing the estate taxes. They're talking about changing capital gains. All of these things mean you get to keep less of your money. And at the same time, they're talking about problems with Social Security, and they're talking about how inflation is going to be a factor. And we're already seeing all of these things. Meanwhile, they're passing trillion-dollar stimulus measures. And by the way, I'm going to back up and just preface this whole conversation, with there is no one political party that has a monopoly on morality or good ideas. And there is no one political party that has a monopoly on stupidity. There's plenty to go around on both sides. And so what we need to realize and really have seen is that as the years have gone by, the spending has increased no matter who's in office. The debt has increased no matter who's in office. And I believe that right now we are living under what is called modern monetary theory, which basically says that the government can rack up as much debt as they choose. They can keep creating more money, building more debt. It does not matter so long as the people believe in the stability of the currency. And right now, things are working. I mean, when we passed $15 trillion in debt years and years ago, it was a big point of conversation when we passed $20 trillion in debt, but we have exponentially passed threshold after threshold, and we're burning away more than $100 million a minute here in adding new debt to the economy and to the U.S. debt and deficit. And that does need to be paid for from somewhere. Although the current environment seems as though modern monetary theory has held true to this point, there comes a day of reckoning. And the way that we do this is that the dollar devalues inflation, or they take more of it from what we earn to pay for the current services that we have, additional taxes. Those are the ways that this eventually plays out. So what do you do? How do you protect yourself, your money, your standard of living, and what you've worked to build up and accumulate for yourself? Well, through planning. That's the answer, is that you need a solid plan in place to address these factors. See, all of these factors are things that you and I and anyone as an individual have very little control over. All of these variables, the market, the politics, emergencies, what goes on geopolitically across the world, inflation, interest rates. None of us can decide those, not as individuals, but what we can do is plan for those things that are outside of our control. We can put a plan in place to say, yeah, there might be volatility in the market over there, but I only want to expose this much of my life, my assets, my portfolio to that market volatility. We can say, yeah, inflation may be a factor, but here's how I have positioned my assets to increase the amount of income that I can generate from those dollars over the course of my financial future. We can say, yeah, they may change taxes up in Washington. The IRS may implement a different set of rules between now and the time I use my retirement dollars, but I've taken steps with the strategies that are available today to control that tax liability in the future. And I think that those are the things that a lot of people have not had included in the conversation about their money. We focus on, what are the fees that I'm paying? Important, absolutely important. Valid topic of conversation. Fees matter. We focus on rate of return. What rate of return can I expect? Absolutely important factor and a valid point of conversation. But ultimately, it's what can we control to the best of our ability. And I think that these factors that are outside of our control are the things that dominate the news headlines. Because when we're out of control of something and it's happening, we feel afraid and we pay attention to it. And that's what the news likes to focus on, because if it bleeds, it leads, it leads the headlines, and it gets ratings. That's their number one job. What they don't focus on is what we can control. What steps can we take? And those are the things that at Rashawn Planning, those are the things that we focus on. We help our clients, savers and investors that want to better determine their outcome, focus on the tools, the strategies, the opportunities to determine that outcome, to control those variables. And we do that through proactive tax planning, through proactive investment management, through proactive income planning for retirement. And that's all part of that optimized retirement plan. And with the question of taxes alone, I have run scenarios. We run a retirement tax analysis that has literally been the difference in several hundreds of thousands of dollars over a client's lifetime for their expected tax bill. Now, that's money that you either pay to Uncle Sam or you get to keep for yourself. And I know which side of that equation I would rather fall on. We have run Social Security reports and analysis. And I know that the schools of thought on Social Security are run out and get it as soon as possible the day that you turn 62. And then at the other end of the spectrum, there is the wait until 70 because you're going to get the most out of it. Well, nobody knows, because that's ultimately based on how long you live after you make that decision. But there are factors that go into that worth considering. And the difference between a poorly timed decision on when to claim and collect Social Security versus a well thought through decision, taking all of those factors into account, also can be the difference in several hundreds of thousands of dollars over your lifetime. So those two things right there, taxes and Social Security, those two things literally can make a huge impact on money that you either need to generate, have saved and accumulated, and then will need to generate from your personal portfolios, or that you get to just keep more of what you currently have there, be more efficient with it, and get more from that benefit that you are entitled to. I hear people say, well, I don't like the word entitlement. It makes me feel kind of weird, a certain way. I am entitled to Social Security, and I'm only 40 years old. I'm probably not going to see it in its current form or fashion, but I have paid into it for more than 20 years. I mean, I started working at 14 and a half, and I have been paying into Social Security now for 26 years. I am entitled to that benefit, just as you are if you have worked and contributed or been married to somebody who has worked and contributed to that system. We want to get the most out of it because we are entitled to it. It doesn't matter that the politicians in Washington who are not financially responsible, again, no matter what side of the aisle they may find themselves sitting on, keep spending more and have mismanaged that. Doesn't matter. I'm still entitled to that, and I want to get the most I can out of it. And so if you feel the same way and you're closer than I am, maybe on the doorstep of making that decision, it's pretty critical that you make a well thought through and informed decision. And the folks down at the Social Security Administration office, well, it's not their job to give you advice on how to best claim and collect. Their job is to help you file the paperwork and make the claim on the day that you show up. They don't know the rest of your situation. They don't know your specifics. They don't take on the responsibility nor liability of providing guidance on whether or not that's the best day to claim and collect Social Security. That's work that you need to do, that you owe it to yourself to do ahead of time. And I can help you with that. And if you would like to take 30 minutes to 45 minutes, that could potentially make a swing, a difference of several hundreds of thousands of dollars over the course of your retirement, pick up the phone, give a call, 919-300-5886. That's 919-300-5886. And we can run that Social Security report and analysis. That actually can be a completely separate thing from the optimized retirement plan or the book. If the question is just how do I get the most out of Social Security, happy to help you there as well. Give me a call and we'll set up a time to do that. We'll crunch some numbers. We'll run through some scenarios. I'll show you where to go to pull your most recent, current, up-to-date numbers, and we'll get you on track there to get the most of what you're entitled to. A striking 40% of Americans live off of Social Security exclusively in retirement. Now, maybe a portion of that is that people are doing a good job in being frugal and keeping a controlled spending and lifestyle. But unfortunately, I believe an even larger portion of that is because that's all that we have. Most Americans have not done a fantastic job in saving and accumulating money. And you know, I've heard this war on the wealthy in the top 1%, another conversation out of Washington recently. Well, the median balance of a 401k account for those ages 45 through 54 is just over $40,000. So if you've got more than that, you're actually on the wealthier side, on the wealthier half of the American public. And I also saw that if you added the total amount of wealth of the 8 richest individuals in America, it'd be about $1 trillion. Well, just the most recent stimulus bill wouldn't even be covered. Don't worry about taxing them. If you confiscated the wealth of Warren Buffett and Bill Gates and Jeff Bezos and several of the other richest people in America, just took all of their wealth, you still wouldn't cover but about half of just the most recent stimulus bill. So it's going to fall to more than just the 1% on how to pay for all of this. And again, if that worries you, if market volatility worries you, if inflation worries you, if taxes worry you, pick up the phone, give a call, and request the time for that optimized retirement plan. Let's take a look at those issues. Let's figure out where you stand with things, what kind of exposure you have, and then what steps you can take to protect yourself against those if they do come to play. Again, for that optimized retirement plan, give a call, 919-300-5886, 919-300-5886, or you can go online, richonplanning.com. Happy to hear from you and help you any way we can. Talking politics, another not widely discussed event that has recently occurred. Now, part of this was widely discussed. The American Rescue Plan Act, that most recent stimulus measure that was passed, it's called ARPA, is kind of they love acronyms. It's the short version of the American Rescue Plan Act that was recently passed, put into law. So a subset of new laws within that ARPA bill affected the Affordable Care Act criteria, the Obamacare, the health insurance marketplace. And what it said basically was that the subsidies are going to be increased, that the earnings limitations are going to be increased. So more people are going to now be eligible for those healthcare subsidies. Well, as a result, a couple things that you may be interested in. If you are somebody who has done a good job in saving and investing and was saying to yourself, I'd really love to retire early, but how am I going to pay for healthcare? This may be something that addresses that question and that concern. You may be able, with much higher income limits now in place for those subsidies, you may be able to get a reduced cost of care if you were to retire, say at 62 and needed to make it to 65. It used to be, well, insurance is going to be $1,500 a month. Where am I going to come up with that extra $18,000 a year? How can I work that into my retirement plan? That's a large sum of money for a lot of people. And it is. But now with the passing of the ARPA and the provisions within it about the subsidies and the limitations for the Affordable Care Act, you may be eligible to get a reduced cost for those health insurance premiums pre-Medicare age. Something to look into. The second part of that is that we've got to pay for that from somewhere again. And so that is something that we need to look into. We need to understand how that could affect us. You're also going to see here, and here's how it's going to affect many of us. I believe that as a result of the way that was structured, you're going to see a lot of companies that are going to begin offloading their employer-sponsored healthcare plans. They're going to look at their employees, say, hey, we're on the hook for a whole lot of money. And actually, even with what we're paying, we're not offsetting the cost to the employees. They could, in fact, go get a cheaper plan given their income, which we as the company know. Given their income, they could go and get a cheaper plan on the healthcare marketplace. So guess what, employees? We're going to save you money and we're going to stop offering health insurance. I'm pretty convinced that's what we're going to see as a result from this. And you're going to, I believe, begin to hear an awful lot about that. Well, you're going to need to understand where to go. And so these are kind of all factors that we take into account as we're putting plans together. We're staying informed on these things. Another aspect here where government and money, politics, and finances mix is at the beginning of 2020, they passed the Secure Act. That was January 1st of 2020. It was kind of the first gift of the year that government gave us. They passed it the last week of 2019, put it into effect January 1st, 2020. And basically what it says is that we're going to collect taxes a whole lot quicker. Now, they gave us a reprieve of 1.5 years. They pushed back RMD's required minimum distributions. That's where the IRS begins to require that you pay the tax bill out of those tax deferred accounts. But on the other hand, they did away with generations of available tax deferral by saying the stretch IRA is no longer available. Retirement accounts that are passed to the next generation must be liquidated within 10 years. And by the way, you still must take the required minimum distributions for years 1 through 9. You have to take out at least that minimum. But by year 10, by the end of year 10, the entire account must be liquidated. Well, that's going to be a higher income amount. That's going to be a lot of dollars that are liquidated really quickly. That's going to create a windfall for the IRS. That's more tax money that is going to be collected from my savings and investments, your savings and investments. Anything that is transferred to the next generation that is tax deferred is probably going to have a higher level of taxes that go to Uncle Sam as the primary beneficiary rather than your family and intended beneficiaries. So these are items that we talk about in planning. You know, that one's kind of the last one, the legacy. But if we take care of your income, your investments, your taxes, your healthcare, chances are that you will leave a legacy, and we want to be efficient with that as well. Those are all topics of that optimized retirement plan. And if you'd like to get that put together, if you'd like to take a look at any of those individually or all together, pick up the phone, give me a call. Happy to talk with you. Happy to set a time that is convenient for you and work on that plan together. 919-300-5886, 919-300-5886. I look forward to helping anyone who is serious about their planning, their financial future. If that's you, if you'd like to take the steps to get that plan put together, give me a call, Peter Rashan at Rashan Planning, 919-300-5886, or go online, request a copy of my book, Understanding Your Investment Options, at richonplanning.com. My last name, RashanPlanning.com. Thanks for tuning in today to Planning Matters Radio. We'll talk to you soon.
This has been Planning Matters Radio.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.